TheoTrade. This is Don Kaufman. It's May 19th, 2023. 30 minutes to go to the cash close here on this Friday afternoon. Are you getting gamma squeezed? Of course, the marketplace exploding to the upside. But people, it's all about big tech. And we're actually going to show you here momentarily evidence of the gamma squeezes, which are literally like the hallmarks of the gamma squeeze. It's everywhere right now inside of this marketplace. But before we get there, let's talk a little bit about the market as a whole. As I said, just about 30 minutes left inside of the trading week. S&Ps right now are off 1150, which timeout right there. That is astounding given the fact that there's been some very negative news that has come out throughout the course of, well, today's trading session. I mean, again, what we term the debt ceiling discussions, yeah, those are not necessarily going that well. But the one that was the real kicker happened to be from a speech from none other than Jerome Powell, which in my opinion was rather aggressive. But we're going to look at that. We're going to look at that here momentarily. Anyway, to start with, let us look for just a brief moment right here at this is the 30-day 1 hour. Once again, people, we are inside of the range. Now, one of the things I was pointing out, well, substantial amount lately is, look, whether we're up here at the 4211, it's just a critical level. It is the upside, okay, of the range that we have seen now for, well, it's the past 7 weeks. Look, I'm looking at, 30-day 1 hour, but look, let's actually do this justice. Let's even open it up to the 90-day 1 hour to see the full extent of this range in all of its glory. But again, right here is the upper edge of that range. Obviously, the lower edge of the range. To give you specific levels for this, down below here, it's 4106. Okay, upside is 4211. One of the things that I was trying to point out and why I'm so adamant at the 4211, if you will, certain boxes have to be checked along the way. And actually hitting the upper edge, okay, of the channel that we're in, I think is critically important. One of the things I've been talking about just extensively lately is that, yes, I carry, okay, bearish positions. I have no problem actually showing you, but my bearish positions are for a much longer duration. I'm carrying big time negative delta. I mean, that's just the delta and negative delta of this particular account. I mean, people, there's a lot of different accounts in here, a lot of different accounts where I've actually got some negative delta in the accounts, and that's fine. Okay. Obviously, you're like, well, but you're taking a hit to the upside. Look, as I've said, week in and week out, okay, I believe that in many cases, we got to go up, explode higher to ultimately resolve lower. And that's simply because, I mean, the world right now wants to be short. When the world wants to be short, you get things like squeezes. And right now, we've actually got compounding of effects of what we term a gamma squeeze and a short squeeze, which is actually just, bam, slamming the market to the upside. And that's what I want to start with is obviously 4211 is hit. What now? But, and I say evidence of gamma squeezing is everywhere. Let's remind everybody what the gamma squeeze is, okay? Because it's one of the most critical things in today's marketplace. One of the first things I want to mention, okay, is yes, we're right here at the 4211, but don't read into it. Like when I say don't read into it, what's the difference? When I say the 4211, what's the difference between being at 4211, okay, 4106? And you're like, about 100 points. Right, but look how many times we came up to the 4211, right back down. It came up here and right back down. Like how many times do you have to see it? Now, the 4211, if we pull this on a much larger time frame here, okay, you'll see that the 4211, it's actually a pivotal level and has been a pivotal level literally for, well, I'm all the way back here now. When I say back here, all the way into 2021. It was hit to the upside, tagged, okay, we reverberated a little bit higher, okay, came massively lower, right back to the 4211. I mean, just time and time again. To see us hit this level, to me, it's not really meaningful. If we started getting above it, all right, then you're really going to see a squeezes on. But allow me, if you will, to describe what's so important about a gamma squeeze, okay, along with a short squeeze. First and foremost, the short squeeze. What is a short squeeze? Look, people right now, I'll even bring up just the, we'll go back to this 30-day. People right now are caught short the marketplace. I'm short the marketplace, okay? But those that are short the marketplace and they're uncomfortable. Remember, for those of you that are a little newer to this, when you're short, you want things to go down, right? But how do you short? You open by selling, okay? How do you close a short? You're a buyer. So what happens is when we start to propel markets to the upside, let me make this a little bit more clear so that everybody can see it. But when markets start to kind of propel themselves to the upside, people that are short, they get squeezed. And when they say get squeezed, effectively it means I'm panicking. And what do they do when they panic? They buy. Why do they buy? Because they're buying to close. So they buy to close. We actually squirt, if you will, to the upside. Things get a little crazy in the marketplace. Look, that is a short squeeze. And there's no question that people are feeling a little bit of pain and we're getting squeezed to the upside. But the real driving factor of the short squeeze, okay, isn't just like the S&Ps. It has everything to do, okay, with the gamma squeeze. Now, for those of you that have no idea what a gamma squeeze is, okay, I'm going to explain this in quite some detail. Stocks like Apple, definitely in the midst of a huge gamma squeeze yesterday, like ridiculous size. I saw 50 million contracts traded yesterday, 50 million contracts total inside of the marketplace, which is well above normal. Which makes sense. Yesterday, we kind of spurted to the upside. Take a look at stuff like Tesla. Tesla, the last couple of days, definitely squeezing you to the upside. You saw evidence of this in Amazon and every day but today. Look at Netflix yesterday, exploded to the upside. Okay, NVIDIA. But I'm going to just tell you something right now. Evidence of a gamma squeeze is not on a chart. Evidence of a gamma squeeze, okay, is when you open up total option statistics here on Thinkorswim and you start looking at the number of calls trading, okay, versus puts. If you looked at NVIDIA yesterday, not today, but if you looked at NVIDIA yesterday, the number of calls trading was just inordinate. It was out of the gate in the morning. As soon as the marketplace opened, people started rushing the marketplace to buy calls, traded at the ask or above. That basically means they'll pay anything for the calls. If you look at Tesla today, like right here, okay, what's Tesla doing? Almost 2 million calls have traded inside of Tesla versus about 1 million puts. And again, is it extraordinary? Well, the call sizzle is today's option volume versus the previous 5 days. The sizzle is still 2x, meaning we're trading twice the number of calls that we typically do versus the previous 5 trading sessions, right? It's extensive. The hallmark of it, though, is you start looking at stuff like Apple. Yeah, there's a lot of calls trading in Apple. Microsoft, just on fire, the number of calls this thing was actually trading the last few days. It died down today. There's no question. Even Microsoft, look, there's more puts trading than calls in here. It died down. But again, if you will, evidence of the gamma squeeze is everywhere. Now, for those of you that have no idea what a gamma squeeze really is, okay, in a brief summary over here, look, you go out, you or any proprietary trading firm, there's a lot of prop firms doing this now too. You go out, okay, and you buy calls. Now, when you buy calls, what are you doing? You're actually making yourself what we term positive delta. And let's say you buy like a 10 lot of calls and you buy like a 50 delta call. Okay, you're actually long, right? 500 delta. So you made yourself long 500 delta. Then we have a market maker. Okay, we're going to label that the MM. The market maker goes around and sells you, those calls. They sell the calls. So let's say that you bought the calls, the market maker sells the calls. Why does the market maker sell the calls? The market maker sells the calls simply because they want to capture the bid offer spread. But the problem is it makes them negative delta. So they're short, and again, I want to make sure everybody understands this, they're short 500 delta. The moment the market maker actually shorts 500 delta, okay, they have an algorithm instantaneously. When I say instantaneously, it's people, they trade, okay, and they look at quotes in billions of a second. They turn around and buy 500 shares, okay, of what? Let's say of Microsoft. They buy 500 shares of Microsoft. It doesn't matter what you think about here, okay? You buy calls, you're forcing the market maker to sell you the calls, right? Take the other side of the position, but then you're also forcing them to buy 500 shares. So the moment they buy 500 shares, the stock goes where? I want you to think about that. When you buy stock, where's it go? It goes up. And then, by the way, when it goes up, if anybody has existing positions on, they have to re-hedge. Imagine then somebody else comes out and they buy more calls. If they buy more calls, it's going to force the original, the original firm, their delta is going to get more steep. Instead of being short 500 deltas, then Nope, now they're going to be short 600 delta because somebody else bought calls. They're going to be short 600 delta. They're going to have to buy another 100 shares. And you get caught in these like loops. Okay, it's feedback loop. It's positive feedback loop where you get caught in it and you just kind of spurt to the upside. Anyway, there's evidence, as I said, of these squeezes. Like yesterday was ridiculous. Evidence of these squeezes everywhere. So not only do we have this gamma squeeze, we have this obviously, this short squeeze going on at the exact same time. Just compounds the risk over there. But lo and behold, it's kind of ironic because I talked so extensively about the 4211. We're going to hold 4211. That's it. Okay, what now? We don't know. I mean, the gamma squeeze could go on. Like they can make attempts at that, but the news coming out over the weekend, like there was rough news today, and it did not seem to negatively impact the marketplace, right? But very, very rough news that came in. The debt ceiling thing again. Jerome Powell, I thought was kind of aggressive out there. Nevertheless, okay, some of the risks are kind of compounding, and we're going to discuss that here momentarily. So what now? Okay, you got nothing at 4211, and again, being at 4106. Is the same thing to me as being at 4211. You go, what? Okay, well, look, it only took like what, 2 days to get there. So what's the difference? What's the difference? I'll tell you when things get interesting. Things get interesting if we break off the 4211, okay, and you start going back into a squeeze situation. Now, there's no way to predict that. There's no evidence of it. Okay, the things you do want to watch, though, obviously the big tech stocks. But one of the things that was a key player this week that, I don't think anybody saw coming, including me, right? Is that the financials actually broke to the upside of their expected move. The energy sector, okay, made a valiant effort to make a little bit of a bullish move literally today. Not much, but the financials helped fuel the S&Ps a little bit. Today, obviously, everything is kind of stalled out. All right, so, the answer to the question, what now? Okay, look, 4211 is just another box to check off. If we start breaking above it, that's when we start squeezing again. And if you want an exact number, look, people, you get to like 42.30, it's on at that point. You get up to like 42.30, and we got close today. You get up to 42.30, we'll start to squeeze again because the shorts are going to freak out. And if the shorts start to freak out, then traders are going to come in and start actually buying calls again and go back into a gamma squeeze. Again, it's these feedback loops, and it's ugly. Okay. All right. Is it over? Okay. Bonds and VIX see risk. And I want to be very specific over here. I don't want to actually look at VIX. I want to look at VVIX, right? So I want to point out one thing that is a little bit alarming is that VIX is actually sitting down here between the 16 and 17 range. But one thing that really is catching our attention is VVIX is rocking today. The markets are not selling off. Look, the fact the S&Ps are down 7 is nominal, but the VVIX, the volatility index, is actually taking off to the upside. Okay, the bond market, very disconcerting to me. The bonds see something coming, and I don't know what that is yet. And that's why I say, is it over? Okay, is what over? Exactly. Right? Like, look, the bonds are implying, let's cruise over to the TNX. The bonds are implying rates are going to explode higher. Like, how much more can this marketplace take? These rates have already taken off now. They're at 3.7. Okay. These things go a little bit higher from here. At what point is big tech going to start to panic? Okay. There's no fundamental behind anything that you're seeing on the screen right now. Okay. All the trade that you're seeing on the screen right here, right in front of you, okay, is nothing more than, quant. It's gamma squeeze, it's short squeeze, it's just all quant. So, you want to look at technicals, whatever, I don't care, but there's no fundamental, issues other than the fact that there's no fundamental issues in play. I mean, we're just basically squeezing to the upside over here, and, price doesn't really mean anything. When you guys think of like, who would want to buy stock, at this level? Okay, and the answer to that is a market maker that needs to buy stock to actually hedge the position off. So the one thing that's very apparent is risk is definitely building on here. There's no question about it. So the bonds are starting to sell off. The VVIX has actually caught fire. The skew is really elevated. Like, those are very disconcerting areas. It doesn't mean that we're going to go down. It doesn't mean that we're going to go down. Okay. But I'm going to tell you right now, it definitely means that people are hedging just in case we do. All right, onward from there. No pause. One of the things that's been shifting a lot lately is right here. Just this morning, and I want to be like crystal clear about this. This morning, okay, this is the probability of a rate hike. Okay, so it's pause or no pause, right? This morning, that was sitting at 41%. This morning, there was a 41% chance of 25 basis point hike. The point that I'm trying to make with this, okay, that's a 25 basis point hike. Again, current rate is 5 to 525. This is 525, 550. And the reason that I'm actually bringing this up is because, again, the marketplace, it's all over the place. They're not sure what the Fed's going to do. They're just literally, it's so, okay, and such a fluid situation. And I'll tell you why that backed down. It backed down. It's like no pause. It backed down because the debt ceiling crisis. Like the market is pricing in the debt ceiling crisis, but it's pricing it in the bond market. It's pricing it in the VVIX, but it doesn't seem priced in the S&Ps. It's like the S&Ps don't believe, okay, that we're going to have an issue. Now, the one thing is, like, again, I kind of stated this last week, is that markets could even explode to the upside if we go into technical default. Yeah, I'll talk about that again. All right, onward from there. So this is also, when I say that there's no basis, no fundamentals behind what's going on, Foot Locker. You know, normally I don't mention like one individual product over here, but Foot Locker, it has been contagious today. Okay, Foot Locker absolutely tanked. And by the way, I'm not sure that I fully enunciated. If you're looking at this chart right now, you're like, what? It hasn't done anything. No. It's down here. Yeah, that's it down there. Stock's actually down what? Almost 30%. It's down almost 30%. And there's some degree of contagion around this. But in my estimation, it's not enough. It's just, in my estimation, it's just not enough. You start looking at this, okay, so Nike is down, you know, almost 4%. And I looked at stuff like Lululemon, okay, and Lulu's down like, you know, not even 3%. And I looked at, you know, like Dick's Sporting Goods. Look, okay, I think everybody needs, Dick's Sporting Goods actually is taking more of a hit now. This is surprising because it wasn't down this much this morning, but there is degrees of contagion, okay? And you can kind of feel it in the marketplace. Watch carefully. First of all, Foot Locker, is that, you know, like a major stock? Absolutely unequivocally not. Frankly speaking, I didn't even think they were still in business. I'm not joking about that. I really had no idea they were still in business. But the thing is, and the fact of the matter is, okay, that kind of trade resonates with me. Like it's discretionary, and discretionary it's a really ominous sign for the marketplace. And you can see everything from Under Armour to Nike, okay, to even like Lulu, okay. Lulu's taken a little bit of a hit here, and again, it's only 2.6%, but this is something you got to watch every earnings right now, because if Foot Locker is contagious, and I don't mean it's like nothing to do with Foot Locker, it's just kind of a fun one to mention, but if there's some degree of contagion, it would basically indicate that the consumer is actually tapped out. And this is something we're going to have to watch, because all of a sudden fundamentals don't matter until they do. All right, one last thing on this particular front. I wanted to talk a little bit about regional banks because it's been off everybody's radar screen. I want to reiterate something, and that's this. If you look at auto expected moves, we cracked to the upside of the expected move, pulled back. The one point is worth noting. We can't get off the mat. We are basically still sitting at or near lows and recent lows, and the regional banking crisis is far from over. I just want to keep this in mind, and I want you to keep it in mind, because you're seeing all of these signs on here. Like, there's not a lot of good things to talk about, and markets don't care. That's why I say that 4211 is no different than 4106. I say that because, you know, look, there's not a lot of good things to talk about. So bonds and VVIX see risk, okay? You know, there's evidence of gamma squeeze until there's not, until that, you know, Foot Locker could be indicative ultimately of what? Of the consumer being kind of tapped out. There's still regional bank issues, okay? Don't take my word for it. Look at a regional bank ETF. That's a scary premise. You know, look at stuff like, here, you know what? Don't take my word for it. Look at stuff like Charles Schwab. It looks exactly like, okay, that sector. It is a marketplace that's got some big issues ahead of it, right? The Fed fund futures are all over the place. That's, you know, the probability of the Fed still hiking was on the table this morning, but all of a sudden goes from 41% to 17%, okay? There's huge economic issues in play right now. And that's why, you know, if you're getting gamma squeezed, ease up on yourself. You're going to be just fine. All right, moving along over here. Get your trade on this week's profits and losses. First of all, the very first thing I want to talk about with profits and losses, okay? My directional bias is my own. I take negative delta because I want to take negative delta. Any of the premium selling portfolios, though, okay, completely and utterly unimpeded in any way, shape, or form, okay? I haven't lost one penny directionally biased because what I'm doing in premium selling is absolutely the most consistent thing we can possibly do. All I'm doing is selling some premium, okay, and managing the risk around it. And you know what? I'm a little under allocated right now, but it's critical to understand that selling premium works. Who cares that we're trading 42.11? It was advantageous. So I went out, okay, and was actually able earlier this week. It's kind of ironic. Earlier this week, I covered short calls, meaning I actually bought them back. Then we exploded higher, and I was able to actually open more short calls. So what effectively did I do? Okay, well, one of the things I did is actually these 45.80s, I bought them back for $5, but I was able to sell them again. And I sold them again. When? Today. Okay, I sold them again, but bought them back, sold them again. I also opened up some new positions. Okay, one of those was actually selling QQQ calls. Okay, and if we keep squirting up higher, I'll probably sell some more calls out there. Again, it's very advantageous with the kind of runs we've had to the upside. But I also closed profitably bullish spreads. I always get accused, you only take negative delta. It's not true. In the catapult, I actually closed a NVIDIA spread for over $5. Then I had a $3 wide spread in the QQQ that I actually closed for about $1.85. Those are trades I didn't pay for. I mean, it's kind of nice to have like a $5 winner when you paid absolutely zero for it. And that trade was completely financed. So onward and upward over here. Again, I'm using this 42.11 as a very opportunistic level. The last thing that I talk about each and every week over here. Obviously, this week has just been, marked with, I'm squeezing to the upside. And evidence of that, of course, is in the SPX. Now, for those of you, if you've never tuned into this and you have no idea what we're looking at over here, this is the SPX Expected Move. This is how the option marketplace handicaps risk. And if you will, this week, the week that we're presently in right now, the expected move is plus or minus 63.85. And I want you to see where we are right now. We are on it, people. Like it's literally on it. And you talk about efficiency to a marketplace. When I say it's on it, you see this line? That line was drawn last Friday. Where are we right now? We are on it. It's ridiculously efficient. I mean, you have a $4,188 product, okay, that is missing a line that some guy drew a week ago. That's efficiency right there. We're hitting the upper edge of the expected move. Okay, look, we could still, pop a little higher in the next 9 minutes, but neither here nor there. This is just a perfect hit. Now here's an area though that's very interesting. So the risk this past week is about $64, which looked a little low to me, and we did crack outside of it and came back in. But the interesting thing is moving forward. One of the things that you want to use expected move for, it's not about hindsight. Hindsight is always so lovely. It's about, okay, what are we doing this next week? So next week, again, ends May 26th. Now, very important, okay? We're also kind of projecting into a holiday weekend. Right? So when people are talking about holiday week, when I say projecting into a holiday weekend, May 26th, okay, is the Friday before a holiday weekend. You kind of expect some of the risk to kind of peter off a little bit, maybe a little bit, towards the end of the week. Nobody wants to trade on a Friday into a holiday weekend. If you're here on living in the Virgin Islands, people start taking off on Wednesday into a holiday weekend. That's that crazy. Anyway, there's about a $63 expected move. It's identical to the previous week. So yeah, you're in store for another, fun-filled week of volatility. It's 63, $64. You think, it's not that big. Okay, look, all right. You're going to hear a lot about the debt ceiling. I think the marketplace could actually feel the fear a little bit. That's why the VVIX is possibly coming up. Again, it doesn't matter what you think at this point. It's all about the 42.11. It's about the 42.11. We either just ignite and explode higher off of it. Okay, we're going to come down and be sitting at 41.06 like it's nothing. We're still, and this is so frustrating to talk about, we're still in the range. We're still in the range. We haven't cracked the range. Okay, look where we are right now. We haven't cracked the range, which makes the marketplace still unbelievably binary at this point. Where stones throw off exploding higher or coming off lower. Keep your hands and feet inside of the vehicle at all times. This next week of trade, There's a lot that's been thrown at this marketplace. There's a lot more coming. There's more data coming out. There's more debt ceiling talk coming out. Okay, people, this is far from over. This is just getting interesting. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye bye.